Hello, welcome to this outdoor version of Brandon's blog. For those of you who don't know me, my name is Ira Smith, president of Ira Smith Trustee and Receiver Inc. First, we hope that you and your family are safe, healthy, and secure from this coronavirus pandemic. Ira Smith Trustee and Receiver Inc. has been fully operational and continues to be. Both Brandon Smith and myself are answering everyone's questions and helping everyone either by telephone meeting or video meeting. So if you have any questions at all about this Brandon's blog or anything else, please shoot us a message, give us a phone call. We would love to speak with you. This Brandon's blog is about what happens when you default on a mortgage in Canada. We take it a step further and talk about strategically defaulting on a secured loan, and then take it one step further in reviewing a recent court decision and talking about how strategically defaulting on a secured loan like a mortgage or a vehicle loan can actually help you settle all of your debts. So I hope you can watch until the end of this video. I know that you will get value from it. As I mentioned, this Brandon's blog is about what happens when you default on a mortgage in Canada and using a strategic default in order to settle all of your debts. What does Brandon mean by that? Whenever we provide anyone with their no-cost initial consultation, we want to understand first what all their assets and liabilities are and what their income and expenses are, their household budget. We then look at a variety of factors, including can they afford to keep paying on the vehicle that they have financed? Can they afford to keep paying all of the costs associated with their home? Are they looking for an opportunity to get rid of the vehicle they currently have because it's too expensive and they could replace it with a less expensive vehicle? Or is the reality that they could rent somewhere for less money than they're currently paying to keep their house, which may or may not have any equity in it for them? So when we look at all that, if it makes sense to return the vehicle secured by financing, or the home has no equity in it, or it has equity but the person just can't afford all the payments necessary to maintain the home, then looking at a strategic default is of utmost importance to settle your debt. What do I mean by that? The person may want to return the vehicle or put the house up for sale and stop paying the mortgage as a strategic move. As difficult emotionally as that might be, it may make better financial sense, because once the lender, either the vehicle financer or the mortgagee, the lender on the mortgage or mortgages against the house, realizes on the security by selling it and suffers a shortfall, that shortfall is now an ordinary unsecured claim against the borrower. That is especially true on a mortgage. In the United States, most mortgages are what's called non-recourse. That means the lender, the mortgagee, can only look to the home or the property that's secured by the mortgage to get repaid from. If they suffer a shortfall, unless someone has specifically guaranteed the loan, they can't go after the homeowner. But in Canada, and especially in Ontario, it's normal for mortgages to be full recourse. So that means that whatever shortfall there might be after the mortgagee sells the home, they can then go after the homeowner, the borrower, for the balance automatically, than going to court to get the judgment on the shortfall. But the mortgage security itself makes the borrower liable for the shortfall. But the shortfall is an unsecured claim. So once you have done the strategic default and you're just left with the unsecured claim, that debt plus all your other unsecured debts like credit card debt can then be settled through an insolvency proceeding, preferably a proposal, but if a proposal is not possible, then bankruptcy. We have also had many situations where there's equity in the home. So the owner puts the house up for sale. And since the house is up for sale, they default on the mortgage to save cash. A strategic default, a different kind. Then when the house sells, the mortgagee or mortgagees get paid off in full, and whatever's left over, the borrower pays over to us as their proposal trustee because they filed a proposal, so that it goes towards the necessary funds in order to settle all of their debts through a proposal. And that is a very, very good strategy for someone who wants to settle all their debts. The court case Brandon discusses below in detail had to do with a person who filed a proposal. They owned 2 homes, and against both homes there were 4 mortgages against each home. The woman who filed the proposal had a sale in place, an agreement of purchase and sale, but the purchaser, understanding that the purchase price would not be enough to cover some of the 3rd mortgage and all of the 4th mortgage, there'd be big shortfalls, put in as a condition in the agreement of purchase and sale that the vendor either had to produce discharges for all the mortgages or go to court and get a vesting order, vesting out title from the vendor to the purchaser and discharging all the mortgages. The cash being paid would stand in place, and then the court would decide in what order and what priority the debts got paid off. The borrower, the vendor, made a motion to court to get that approved because she couldn't get discharges from all the lenders. The 4th mortgagee objected. Now, the purchaser was silly in not instructing its legal counsel to go to court on that application to make sure nothing went wrong. But what happened was, so the purchaser and the purchaser with legal counsel were not in court. The purchaser was not represented that day. The 4th mortgagee showed up and said, I will pay more for the home, and you have to sell it to me, court, because I'm the 4th mortgagee. So the court made an order actually approving the sale that was in place, because that was a binding agreement, but gave the 4th mortgagee several days to make its better offer. And it did. So now the original purchaser went to court to object to that, because they were not in court when that order got made, and they are going to suffer because from their perspective they have a binding agreement. There were all sorts of arguments and debates back and forth, but at the end of the day, the court said of utmost importance is that this sale has to be seen as fair. Fairness has to prevail. So what the court said was every agreement between those 2 possible buyers that exist are void. They're wiped out. Now, each of these potential purchasers has the chance to put in their best and final offer. And they have a few days to do it, and their closing date has to be the same closing date as originally was the case. And if the winning buyer can't close on that date, then the other party can buy it. And that's what happened. So the court looked at it and said, selling it through the proposal is fine, giving the vesting order is fine, we just want a fair bidding process. The offers had to be submitted to the trustee under the proposal, the trustee would pick one, and presumably the trustee would come back to court with a report, advise the court what happened, and get a vesting order to vest out the asset to the winning buyer. So I hope you've enjoyed this Brandon's blog. Please read the details below. There's more details than I put in this video. Again, we hope that you and your family are safe, healthy, and secure. Ira Smith Trustee and Receiver Inc. is fully operational. If you have any questions at all about this Brandon's blog or anything else whatsoever, please shoot either Brandon or myself an email, give us a phone call. We would love to hear from you.